How's it going?
Excellent.
Excellent. So Rafi Tahmazian's here with us from Canoe. He is the lead portfolio manager and an award-winning one at that. He's been in the investment business for over 30 years. And he also spent 13 years at First Energy as a fierce competitor. And
That's right, Jessica.
We're going back. But yeah, he's certainly is an expert on the space, and we're looking forward to hearing your insights.
Yeah, good to see you, by the way.
Nice to see you as well. It's been a while.
Yeah. Thanks for having us. And I can't recall exactly the last time I presented for you folks, but it was kind of if I'm not mistaken, in the early stages of the pandemic. And at the time, I went into a lot more about our strategy and how we invest. But really today, I'm going to skip a lot of that, and I'm going to jump right into the meat and potatoes of what we think is how we think you need to think about this sector, and what we think is going on in this market. And also, due to my lack of technical abilities, I've got Vic there forwarding moving my slides. The first thing I want to talk about really is an understanding I want everybody to have. And some of these companies that have been presenting for you in your conference are demonstrating this to you probably, and you're hearing this a lot. But the market is not necessarily aware that the world of energy has changed dramatically in terms of investing in it and how we would have invested in it in prior cycles versus this one. And I think people really need to understand that this industry is consolidating, and there's one major group that's going to be developed that are basically these distributors of cash, if you will. And they're becoming massive, big manufacturers of oil, driving the cost of that down and building a bigger and bigger inventory. And they're going to slow down the volatility of how you would be perceived to own this sector. So a lot of people might think that the energy sector is a volatile sector. Well, it was. And there is going to be a degree of that in the junior sector. And I would call the juniors, say, under 50,000 barrels a day now. But anything over that has sustainability and the ability to actually create free cash flow, they're going to start distributing that. In fact, they have already started doing that. And so when investors come in and look at this sector today versus, say, what you and I were competing against, Jessica, that you were referring to, in those days, it was grow, spend multiples of your cash flow, grow your debt, crank your debt up, have these hockey stick curve commodity prices that you need, and grow your reserves per share over time, hopefully. That type of model is really not going to exist again. And it creates a lot less volatility when you own the sector. Now, if you go ahead there, Vic, to, I want to say, slide 6. Thank you. So these are the 9 subsectors that Dave and I look at the energy industry as. This is what makes it up. It's a very robust image of energy today. I think it's really important that people understand that energy is not only not a volatile industry to be invested in anymore, but that it is so many things in your life. It's not just the oil and gas producer. It's the transportation and the complexity of that. It's the exposure to a certain degree at certain times in what we call alternative energy and the technologies in energy. It's trying to invest at the right time in the services that will provide when the producers start to spend more in the basin. All of these things create a massive portfolio of opportunities. And we look at them all as these 9 different subsectors and we pit them against each other. And so you you're going to kind of hear us talking in that vein when we're referring to the sector in this presentation. I'll take you to the next one. So let's go into this, the kind of what we think the current situation is right now. And appreciating that we come at it from these subsectors, I look at it more now, the industry from where does it look relative to the other industries out there? We start with this very top-down approach. This chart on the left, there's a lot of stories that can be told by that. And some of them are tangible, and some of them you might call our behavioral economics that we use. So here's what you should read from that. The green wedge there is all of the money that has gone into the S&P, new money into the S&P that was not labeled ESG. So all the SPACs and all the new money that went into technology companies or maybe even lumber companies, whatever, it amounted to about $500 billion since back in early 21. ESG had got allocated, anything with an ESG label got $1 trillion in total. New capital went into it, okay? Now, the expectation was that there was a lot of guilt and a lot of fear that people felt they needed to contribute and invest in that sector. And they were also convinced that it was going to replace this dirty oil. So get involved early in this great new growth sector. And piles and piles of money went into it. Like I said, $1 trillion versus every other industry combined was $500 billion. Now, the problem is we can actually now assess what happened there. And the $1 trillion was thrown into a very small pile of names. And you can see as that money went into the funds, the fund managers just turned around and kept piling them into the same names, ramping up the values of these things. And they skyrocketed until the mid part of last year. Now they're all off kind of 50, 60, 70%. The valuations of your ESG funds have been decimated. And that you're sitting there kind of feeling the pinch from your investment. But at least you put money into ESG and they were finding alternatives for oil, right? Well, what we're here to tell you is the alternatives didn't show up. In fact, it looks like there was all it did is made us understand just how risky these experiments still are. And maybe it wasn't appropriate for pension funds to be putting money into these kinds of things, or even just your average person investing in it. This is more risky capital than everybody thinks. It's meant for much more, not the risk averse capital that did go into it. And so the money went in there. The money got devalued quite severely. The alternatives didn't show up. But I'll give you one more that's even more alarming, is human nature. And what we found in the developed world, where a lot of this money was put into the funds from the developed world, or the OECD countries, for the last 15 years prior to COVID, we had arrested our growth in oil demand. We were using the same amount of oil for the last 15 years. We weren't growing it anymore. We were growing our energy demand, but we were replacing that with natural gas. But up until COVID, we had stopped growing our oil demand. Except post-COVID, we're growing our oil demand in the OECD countries. What is that because of? Partly it's because people gave money to these ESG funds thinking that there was going to be a replacement. And so they went on continuing to use their oil. But not only that, we fashion it to kind of like when you go for a run in the afternoon, and then you go out after work with friends and you think, well, I went for a run, so I'm going to have a drink. Well, they go, I've invested in ESG, so I'm going to use even more oil. And now the developed world is actually growing its oil demand again. And what's even worse is COVID took us from what we called selfless to a selfish situation. And the globalization experiment that we've been doing for the last 20 years started to break down. And we would argue the Ukraine war is actually the critical turning point that gave us the conviction that we're probably going back to the old world of East versus West, or developed and undeveloped, or OECD and non-OECD world. And that's very inflationary if we're deglobalizing like that. All at a time when we need to use our oil, and our reliance on our oil is growing because we are now using it more. 30% of the oil produced in the world is produced by the OECD countries, but we use 45%. It means we are beholden to the non-OECD or dissident countries that would be threatening our security. And that's why also in the medium term, as we see this security issue elevate, we think Canada's oil is eventually going to become very coveted in the OECD world. And that's a very positive thing. Now, what about the oil and gas producers themselves? What are they spending the money on? New money going into the market didn't go into it, as you can see on the left. But on the right-hand side, the activism and the anti-energy movement got into the super majors. And look at what happened after 2013. And we've been drawing attention to this chart since 2015. It was quite alarming when it was dropping. The super majors reducing their spending by 60%, 70%. And the primary focus of spending was on mainly building out refining. They weren't out trying to create any stability in the current production base they had, let alone finding any oil. And so we were not funding it on our side, and they were not spending any money. And that created both a supply, that's why we were in peril with supply. And to accentuate that, as I mentioned, the developed world has gone and turned it into a demand growth environment. Now, the developing world, the countries that don't have a middle class yet, or a healthcare system, or any kind of transportation infrastructure, these people got threatened by COVID, because while we were all finished our second shots and celebrating that we're going for our third, the developing world was at 5% vaccination. And they realized we weren't going to be there really to help them the way we said we would be. And you saw the elevated demand for oil right away. And then we had COP26 come along right at a time when it was already a sensitive issue about their survival. And we demanded answers from these developed worlds, what they're going to do about their carbon footprint. And they basically turned their back to us. And the demand for oil in the developing world is growing even faster pace than the developed world. So now we're at a point where we're using more oil than we were ever using pre-COVID. And on top of all that, we're sitting in a situation where we have no more spare capacity. So if you can go to the next slide there. And maybe one more, please, Vic. So on the left-hand side, this is just a peek at the US inventories. And that's the 5-year average, is that white area, the 5-year peak line at the top, and the 5-year low inventory average at the bottom. And you can see the red line is current. So inventories are perilously low of products and of oil in the US. And what's even more concerning is that the first quarter is always, you can see the slope up to the right. That's usually when you get your inventory builds. But we had a very onerous first quarter for usage, and we see ourselves actually depleting the resource. And now we're entering the period where you deplete it more. So it's going to accentuate the lack of energy available. We are now at a point globally where it's not just, you don't have to worry about just high prices for your energy. There are going to be situations in the developed world where you don't have the energy to provide for what you need. And in the developing world, when that happens, that creates carnage, chaos, and even civil war. So we also see elevated geopolitical issues now, which are also going to help start to, and that has never been priced into the price of oil. So we anticipate that that'll start to develop a lot more as well. If you can go to the next slide there, actually, and then this one here, what we want to point out on the left-hand side is what is the representation of energy to the rest of the market. In the US, in the S&P market, we were back when I did this presentation with you guys last time, energy would have represented about 1.8% of the S&P. That was the bottom of the cycle. Today, it's at 4.5% after all of that move. It's at 4.5%. And Goldman yesterday came out and said, it looks like energy represented 8% of the earnings reported this quarter. And it's only represented 4.5% in the S&P. Canada's a little different. It's a bigger part of our economy, so it's a bigger part of our index. Produces the generalists have to own more of it, but they are reluctant still. We see enormous momentum of the generalists, both in the US and in Canada now, starting to crowd into this space. So we anticipate funds flow will be one of the bigger issues. That is also why it's probably prudent to maintain a fairly high upcap market investment exposure right now, for the simple reason that you can't be, you can sit there and want to play the junior sector, but until funds flow into the junior sector, it's a riskier place to be. And a lot of the new money coming into the sector today isn't just going to jump right into the intermediate and small caps. It's going to end up being basically focused on the large liquid producers. And that's where you want to start. If you can go to the next slide there. So here's some pretty good news too. So here's on the left-hand side, showing you the royalties that the energy industry pays the Alberta government every year, dating back to 1990. And you can see the average royalties paid over that period of time runs just under $4 billion. This year, we estimate that we're going to pay the government $18 billion in royalties. And that equates to, at a federal level, a pretty significant tax number as well. But I put this up here to have people understand how quickly things can change and how fast the debt picture changed. And now not only are the companies doing well, but it's contributing to the economy of the country as well. Very, very significant numbers. You can see the variability in 2023 getting up to almost 28 billion if you use kind of current pricing. You can go to the next slide. So this slide we put in here, but I'm always reluctant to show it because it does show that we're early in the cycle. But the previous energy cycles that are shown on here have these they are cycles that were built off of an energy sector that was spending multiples of its cash flow, ramping up its debt, issuing equity, hockey stick curve projections for commodities, all of that stuff that I mentioned earlier. But remember, the industry has changed. The junior sector might look something like this a little bit, but the intermediate to the large cap group, who are going to be these consolidators of assets, driving the cost of the oil down and distributing the profit back to you, they're going to become more like manufacturers, and the market is going to modify their impression of them from a risk perspective. And we think the group is going to maintain a much higher base level of value going forward, and their volatility up there is going to be far less from now on. The key will be if the producers maintain the discipline of being distributors. And we think they're almost forced to because of the lack of services available anyway. And we're going to talk about that quickly right away as well. If you could skip this slide, the next one, that right there. So what are we currently positioned in? Currently, we are a little concerned about the producers and their ability to control costs the way they have to this point. There is enormous pressure on the companies to try to grow their volumes. The only volumes that can really be grown is anything that doesn't involve a lot of infrastructure, because the government has made it so onerous to build out longer term infrastructure that you won't see any longer term stable volume growth. You're going to go after the shale production, and that's going to be the quick stuff that'll have high declines. It'll need a bunch of capital, and hopefully it'll alleviate some of the supply pressure we have, but it's going to wipe itself out just as quickly as it comes because it declines hard. But if we do put the money into that shale production, we're going to have to put it into the services that hardly exist out there anymore. And so those services are going to start to charge more for their business. So the first thing we're doing, if you go to the next slide, Vic, is we're going to chase these producers that are resilient to costs. And that would be your royalty companies typically. So Topaz, Freehold, and Prairie Sky are good examples of that. And these companies don't get affected by the costs, other than maybe the activity level of the producer might be hurt by it. But really the direct costs are on the producer. These guys get their royalty at the top line. So we would recommend, and we've been building our positions in these groups here, as we've brought down some of our exposure in the more conventional producers. And in turn, the next slide, if you could, in turn, what we've done is we've said, well, if that capital, that all that free cash flow is getting distributed to us, pay down debt, and the rest going into the field, that service company is going to grab some of that profit. So we've been slowly moving over the last 45 days into the service subsector, primarily in the pumpers, and just because of the barriers to entry and the focus on that short cycle oil that we know we can get out of the ground quick, although it is going to create its own problems, a problem of its own. The last slide I want to show you, not this one, but the next one, if I could, is just I want to finish with our alternative energy and energy technology strategy. We think there's almost $60 trillion that's going to be spent in silly government spending in a bunch of these areas that are listed here. And when Dave and I did an analysis of this area back in 2015-16, we recognized a few key areas that we could probably put some money to work in, primarily in areas where we could use our expertise in developing businesses that could help tackle the problems that this dumb money was creating. We saw the wind and solar build out. We saw the inefficiencies. And so we did a bunch of research on battery storage. And we ran into this bulk battery storage business. And that was 5-6 years ago. And it was a concept that was built out of Toronto, a business in Ontario. And it was basically a glorified compressed air energy storage strategy. But he had captured a technology that made it convincing to us to take it down that road. It was a 30 million market cap at the time. It wouldn't have required a lot of investing. What ended up happening was we incubated that business for 6 years. We built out even a test project in a place called Godrich and helped fund that. Put all the effort, our time with the fund's capital into something that was meaningful, that could try to impact and change the economics of windmills and solar panels. We're not greenwashing with your money. Fast forward today, and Goldman Sachs Private Equity announced $250 million US investment in this business. CPP has leached their investment out of that Goldman fund and announced it separately for themselves too. The difference is your early cost base was 30 million market cap. It's now got a 200 million market cap. So we got into a fairly healthy, alternative energy strategy with your capital and trying to move the needle. Another one would be a water recycling business, that taking Canadian water recycling and transfer technology that we are very, astute with, and transferring it into the Permian in the US. And that was a business that was generating $7 million in EBITDA when we invested in it 4 years ago, all of it in Canada. And now next year they're talking about 20 to 26 million of EBITDA, and 60, 70% of it'll be out of the Permian. And it's Canadian technology creating water recycling mindset in the Permian in the US. That's our capital put to work, making real things happen in this sector. But if you go to the last slide here, Vic, these are the positions that represent our alternative energy roughly. They're 12% of our fund's assets today. And quite frankly, that's how much you should have exposed in that sector right now. You should not be aggressively pursuing these experiments. The stuff we put the money into was stuff that we worked on over that 5-year period when there was a dollar was competing for energy all over the board. It's really hard for a dollar to compete with anything but what's happening in our backyard in the fossil fuel industry today. You want to be heavily weighted in the energy sector, the conventional energy sector. And we're planting the seeds for the next cycle with some of these things that you see on this board for the next alternative cycle. Anyway, that I'll leave it there. I don't know, Jessica, how you want to go about it. Do you want to take questions or?
You answered a lot of the questions I had prepared. One was certainly on the service side, which we're seeing in Canada and the US, from what I understand. Shortness of frac crews, things like that. And, I was reading just the other day that they don't think in the US they'll get past probably 800 rigs. And at, the peak, we were close to 1,200. And even with the ducts that are being brought on, they're declining quickly. So the production growth that people were hoping for out of the US is likely not a reality. Yeah.
I mean, I'm actually in Halifax today, and I'm speaking to clients, and one person asked me a question: what would it take to bring on 1 million barrels of new production in Canada? And I was just like, 1 million barrels? That's like a pipe dream. That doesn't even.
Yeah.
And I just said, first of all, any 1 million barrels that a producer is going to take the risk to try to add, well, the big projects can't add anything. You can't add any oil sands projects because we've regulated the industry so heavily. It's punitive because we don't even know what the cost of it's going to be. Look at the pipeline cost for TMX. It's ballooned to over $22 billion now.
Yeah.
That's why they didn't want to do it.
Yeah.
Right?
And the government said we're not adding any more, we're not giving any more money, even though they've guaranteed a loan. And then I just saw, I think today, and this is one of the things I've been hearing from US investors, is that even like pipeline gathering systems and, shorter pipelines are not being approved as well. So why would you build out drill new reserves if you...
How about this one, Jessica? Now we're being accused, the industry is being accused by politicians about gouging at the pump. And,
yes. I love that.
They're correlating it to the profit that the producer's making.
Yeah.
And Jagmeet Singh is publicly stated, and he uses these egregious terms like these filthy rich billionaires in oil and gas. Shame on them while you can't afford the price at the pump. I'm telling you, this is the leader of the new Democratic Party, and that is the most irresponsible statement as a human being. And he has an obligation to be more responsible than that. It's shame on him because that oil, it's a supply issue.
That's right. He's completely uneducated yet feeding both to people who don't know any better.
But I'd be curious from you, having come from, as you said, my competitor, and understanding the energy cycles of the past. Does it make sense what I'm saying, that the industry's in a transition?
Completely. I like everything you said. I concur with. Like it feels different. It is different. I've never, when I've been doing this for 26 years, we've never had this lack of supply before.
Yeah.
Right.
No.
And the lack of funding for these companies.
And when you have a lack of supply like that, it trickles down into the refiners. And
That's
now
right.
products are also getting more expensive. So look at diesel today.
Diesel, I know, I was just about to say, which then increases your food costs like even more than they already are. I mean, we're going to have, food supply issues that are.
Well, that reminds me, I want people to think about this too. Don't forget, inflation is two things. Absolutely critical when people talk about inflation. There's going to be now talk about the possibility that inflation has peaked its growth. Think about inflation like the one that is affected by the supply chain issues and the chip shortage. And then think about inflation from the old economy stuff and the lack of spending we did on those things. I don't care what you fix on the supply chain side of inflation, you're not fixing this one.
No.
So if people correlate this one coming off and the market trades off the whole cyclical group, buy the hell out of that group in the weakness.
Oh, definitely. I mean, it reminds me of after the tech blow up, but even worse, right? Because of these, when in 98, OPEC had 12 million barrels a day of excess supply, right? And they cut production, and then we did have, natural gas prices improve because of changing to cogen and everything else. But we've not seen anything like this in my lifetime. And people totally underestimated. Like, I don't know how Germany turned off their nukes and everything else before determining whether or not their alternative energy would work.
Well, I have numbers on that. This is impressive. If Canadians are feeling real proud of our initiative to try to be green, well, let's just look at the first experiment, and that was Germany. And they started the process that we're on back in the year 2000.
Yeah.
And they started this push to go to zero fossil fuels it was originally 2015 or some stupid number. Then they pushed it out to 2030. Now it's like 2050. At the time, they were producing 85% of their production of their energy usage was created by fossil fuels. 22 years later, this year, they're announcing they have to raise the usage of fossil fuels because of the dilemma with Russia.
And I know. It's insane.
They managed it. And where are they at this year? They're at 76%. So in that 22 years of stupid experiments and pissing away money and all these wind farms that are useless, they managed to go from 85 to 76%.
Yeah, what a win. What a win. And the trillions of dollars that you've spent doing it.
Well, it's really a race because of the global warming and man-made issues. We're losing the battle.
Yeah.
It's not working. So we've got to figure it out another way. And I'm pretty sure it has to do with accepting oil is a part of our lives and we got to clean up the emissions. That's much more likely to be a scenario that will achieve the goals everybody wants than these dumb experiments that have produced nothing. So,
and like you say, these companies that were high risk, they should never have been invested in by low risk money. And now that's been a disaster. And, it's just I'm in total agreement. Everything you've talked about today, I completely agree with you. And yet I still haven't seen that massive inflow of capital yet from the generalists and bigger funds. It's starting. It's starting.
So now you'll see the inflow of capital. And then the next phase, when this sector gets a value to it, you'll actually start to see a capital program start, a significant one.
Yeah.
Let the service sector beef itself up for the next 18 months. By the middle of or end of next year, maybe you'll see a capital program, for instance. We might even see new equity markets, possibly, Jessica, and in that sector, which we will not see early like we typically do in this business, because they're right now cash machines.
Like you say, they were just on these growth trajectories, raising money 3 times a year, and it was phenomenal.
That's how we live it,
Yeah. But no, I think, and one question I had for you on gas, how do you, I see you're more bullish on oil than you are natural gas. That's contrary to a couple of people I've talked to, and I'm just was wondering about your view there.
Yeah, I don't know if I'd say I'm negative on gas. I'm just more bullish on oil, I think. I think you should have exposure to both. I think that only recently, where we saw massive pricing of gas in certain pockets of the world, you could see Canada and North America's gas price rising almost as a derivative of those places.
Yeah.
That is because LNG infrastructure is growing at such an aggressive pace. Gas is now becoming a global commodity.
Yeah.
And we're on the doorstep of that. So for that reason, I feel very good about the sector. But there is a seasonality to it still. I can't, no matter how much you rip that out of me, all my life, I've lived with seasonality with gas. So just
exactly. And summer always disappoints us.
Yeah.
And
yeah. So that's, I'm going to preface that. Yeah.
Now, there was one question from the audience. With an absolutely dismal record of companies setting hedges and collars, why are they continuing to do so?
The first one, the abysmal reporting from the first one, it's only fair to say that if you can not use hindsight, you have to appreciate where these companies were when they put those hedges on and the environment we were in at the time.
Yeah.
And it was to secure a program, and it was just mind-numbing that the companies could actually see that they could make a profit even with a hedge. So we criticize the companies with the hedges now as they're coming off, but you really shouldn't use hindsight. You need to actually, it's such a low form of intellect, eh? Like you have to go back and appreciate what those companies were doing then.
And there was only a few companies that I can think of that really blew themselves up with bad hedging.
If you do it right, you're protected. I think the second part of the question is a valid one. Why are they doing it again?
Yeah.
And I'm not a fan of that, because if you do lock in like that, you've got to respect, if you are one of the bigger producers and you are a cash machine now, you're fixing your valuation to the market for the rest of the year if you do too much of a hedge. Yeah.
And I mean, and really a lot of the hedges last year were forced by banks. So
that's right. On top of that, which is a lot less now.
Yeah.
Well, hell, they're all debt free. They were all bankrupt 2 years ago, and now they're all debt free.
Yeah, zero equity values 2 years ago. And now the banks want nothing to do with them because they signed on with Carney's deal.
And remember, yes. Oh, you're going to go there, are you? Tease me. So that's I think we have to appreciate that the sector is also going to be separated into these two parts, these money distributors and really methodical growth businesses. And then there's going to be the junior sector. And the junior sector will be this volatile thing, I think, that will kind of still resemble the thing that you and I were part of in the 90s and the 2000s, early 2000s. But the vast majority of the production of the country is going to be tied up in these 15 or 18 behemoths that are distributing cash out to you. And just remember where you're putting your capital and what risks you're taking in it as this market matures and develops. But I want to make sure people understand that the risk you're taking today in owning the sector, with what we know now about demand being out of control and supply being in peril, versus a year and a half ago when these stocks were 500, 600, 700% lower than they are now. That sounds silly when I say that.
I know, right?
Yeah. I would say on a risk-adjusted basis, they're cheaper to own today than they were then.
Yes. Yeah. Yes, they are. Yeah. And I've never seen valuations so low for these companies. Yeah. One last question before we leave. We could talk all day probably, but given your bullish outlook, what's your biggest concern about your thesis?
So what's the downside if we're wrong? It's all the only one I can really, obviously there's ones that we can't figure out, like government interference which is, that's a risk we carry in Canada. But I still think you should be focused in Canada right now and taking that government risk. And the other risk you would have is, I hope I dispelled anybody's, we didn't show you the factual side of it, but the data that comes with our thesis that supply is in peril.
Yeah.
You can't just turn a tap on. That OPEC has no more capacity. In fact, they're falling short.
Yes.
So
you see the numbers every week. Like,
the only place you can derail this is in energy demand.
Yeah.
And the kind of significant demand destruction that you need, it's so enormous that I'm talking about a recession that your energy investment will be a rounding error in your life to your other problems you have.
Exactly.
So the downside is mitigated when you think about the kind of extreme situation I have to paint for the demand destruction to occur to actually affect this sector negatively.
Yeah, totally agree. And I'm more bullish on Canada than the US. Are you Canadian stocks versus US stocks?
Yeah, I am. Yeah. I think that we are ahead of the US in cleaning up our businesses because we were forced to start to clean our businesses up back in 2015. These guys didn't hit the ground running until 2019. So they're more levered and they're a little more fat on the businesses. The margins aren't as prolific. And so Canada tends to be the place you want to focus on more. Although our energy service investments, we're including Halliburton and Liberty and a few other US investments. So it takes our US exposure up. I think we run about 15-18% US exposure.
Yeah. Okay. Well, that's great. Very insightful. We really appreciate your time and nice to see you again. Maybe we'll see you in person soon.
We can get back to Calgary.
Yeah, get out of Halifax. Yeah.
I think I'll be in Toronto next week, actually.
Oh, are you?
Yeah.
Okay. Well, have a great weekend, and thank you everyone for your time. And it was great. Really appreciate it.
Take care.
Okay, you too.